This is Scott Becker with the Becker Private Equity and Business Podcast. Thrilled today to visit with Holly Buckley. Holly's the chair of the healthcare department at McGuireWoods and lives at the intersection of private equity and healthcare. Holly, can you take a moment and both introduce yourself and tell us a little bit about what trends you're watching in this healthcare private equity space currently?
Hey, Scott, of course, and thanks as always for having me on. As noted, I'm the chair of the healthcare department at McGuireWoods, national practice, about 50 attorneys, and I sit at the intersection. I'm traditionally a healthcare attorney. I do a fair amount of private equity work within that, although I also do some work in the more traditional provider space. In terms of trends that I'm watching, before we get into trends, I think it's helpful to look at where we are. So it's an unusual year as compared to prior years in that the economy is in a tricky spot. The macro environment is difficult. Interest rates are high, and overall somewhat of an economic slowdown. And that's really translated into the deal world somewhat, but not completely. We like to say that healthcare is somewhat recession-proof or recession-resistant, in that there's always going to be activity in the space, and there's always going to be regulation, and there's always going to be changes. And so because of that, we're overall not totally slow, though we're not where we were in the last year or two. In terms of specific trends in healthcare private equity, I think we're seeing a few things that all are very logical in light of what I just kind of noted on the bigger environment. We're seeing kind of overall less deals in the aggregate, but we're starting to see somewhat of a pickup. And I think we're seeing more LOIs and SIMs come out than we were seeing in the past few months, maybe. We're seeing, I'd say, some shakeout from the past kind of 5 years of really rapid activity, where we're seeing some of the platforms that maybe are not doing as well are starting to have real liquidity issues and have to kind of fight for survival and make some difficult decisions. And I think it was, toward the end of last year, beginning of this year, I think I noted on a podcast that we were seeing a fair amount of, executive turnover of kind of platforms looking to change leadership. And I think we're seeing more continued activity like that in terms of platforms really having to make tough decisions and survive. Another thing that we're seeing is, I'd say, some more exciting, bigger deals come to market that had potentially been holding off through the beginning part of the year and now are looking to transact. And we're continuing to see, I'd say, a slight pullback from direct provider transactions or investments in providers, and more interest in some ancillary businesses such as provider services, payer services, pharma services, digital health, and kind of the one step removed from direct reimbursement type businesses garner more attention and a diversification strategy maybe by some of the investors.
Thank you. That's a great set of issues, sort of more interest in some of the bigger platforms, some of the bigger platforms finding themselves with some trouble, less interest in some of the smaller provider transactions perhaps, more interest in some of the ancillary issues, and some of those big platforms still looking at turnover and trying to make sure they got the right leader and so forth. What a fascinating set of issues. Then you also mentioned sort of, the pace of deal activity started to tick back up, and that's interesting too. Fascinating to see some of these companies that loaded up on debt, particularly debt that's got to be refinanced at the height of the market, with, at one point they got lower debt, now the market's much higher. Some of those platforms really able to figure out cash flow issues in a much more difficult way than they've had to in a long time, it sounds like, too.
That's exactly right. And it's a tough time for some of those. And I think that'll also end up leading to some other transactions as folks try and figure out whether the strategy is to stay the course or to potentially, take one of the difficult decisions and potentially sell early.
And what you see is, from my perspective, private equity funds, very reticent to sell early because then they take a loss in that portfolio, they lose investor confidence in that portfolio, and then that fund may have a little bit harder time raising the next series of funds. And if we've learned anything, is that private equity funds are constantly raising funds. And so, like I saw, for example, this morning, Apollo, and KKR reported yesterday, Apollo today, almost zero exits in the first quarter of this year because they don't want to take exits in a down market or at a negative and negatively impact their profits and losses and what they show their investors. So you see funds very hesitant to take those losses until they absolutely have to, is my impression.
I think that's exactly right.
What a fascinating environment. And so there must be some positive sense with interest rates seeming to be closer to a ceiling, people not seeing so much uncertainty. I think nobody expects, if the federal funds right now is 500 basis points, no one expects that to be going to 700 basis points. And even though debt that's backing and supporting deals is at high numbers, people don't expect them to go much higher. Though you've got this other issue of the credit crunch coming because traditional banks are finding themselves in trouble that were some of the aggressive lenders into this stuff. What is the credit environment? I mean, what is your sense of the credit environment?
I mean, I think it's really tough. I think for facilities that are currently in place, it's kind of, back to the whole relationships really matter in terms of how lenders are going to deal with platforms that are struggling. But I think in terms of looking for new credit, I'm wondering whether there's going to end up being less leverage on some of these platforms instead of, the higher multiples of debt. I think it may end up being lower and more equity going in, but that's just a theory, and we'll have to wait and see if that plays out.
No, it's really interesting, and relationships do matter because what happens with a private equity fund who's got a close banking relationship or finance relationship, that banking and finance partner wants to stay very close to that private equity fund and not see that relationship go south. Right. And so I think you're right on that. But at the same time, it only matters so much because they can't finance stuff or support stuff they don't think is actually going to make it work. And I do hear constantly that this equity debt ratio in deals is changing some right now. As you see private equity funds, some private equity funds have a lot of dry powder, a lot of commitments, and they have to put it to work. Right. And at the same time, the debt market's not as it was, so it's leading them to be much more split in terms of the equity, the debt that's going into these things, is my sense. Yeah,
that's what I'm thinking too.
What a fascinating situation. And as you lead a group of 50 attorneys through these tumultuous times, what's some of your thinkings on sort of making sure your people are taken care of, they stay thriving, they stay busy? How do you look at some of those issues and think about some of those issues? And is it back to, the core of business development, staying close to clients, staying close to the market, and so forth? What do you see out there?
Yeah, I mean, that's right, Scott. And I mean, you've sat in this very seat, so you know exactly how I'm feeling about things currently. I mean, I think it's exactly as you said. It's doing excellent work on the things that you're currently doing and keeping your clients as happy as possible, reminding clients that you're open for business and can help them, and then getting out there and knocking on doors and working on new business development. And then for the folks who are at a more junior point in their career, it's getting them pulled into all of those things, as well as helping them develop their skills and stay fully engaged so that they don't kind of lose enthusiasm and commitment and kind of the chase of the job. And so it's really, as you said, kind of a constant battle to kind of keep people engaged.
No, that's exactly right. Just to keep things busy, keep things moving, stuff like that. We say euphemistically keep the lights on, to keep things humming and stuff like that is what we really mean. Exactly. But it is fascinating because you want people excited, engaged, thriving, growing, all those things while they're plugging along. Yeah. No, Holly, you do a magnificent job. Again, Holly Buckley, chair of the healthcare group at McGuireWoods, one of the largest healthcare transactional groups in the country, transactional regulatory groups in the country. Just a phenomenal work that you do. Thank you so much for joining us in the Becker's Private Equity and Business Podcast.
Thank you, Scott.